Bismillahirrahmanirrahim. Let us move forward with this presentation. As you know that the theme of is about the course launch seminar, and what we would like to do with that presentation is to apprise you why we are going to conduct this the course that inshallah will be following this webinar. I'm going to discuss in this session is that first of all to make you apprise that if we are going to discuss the conventional hedging and repo market and its uses for the financial market, what is the significance of hedging and repo contracts and products for the conventional financial markets? Are they worth considering, and are they generally providing any or contributing any kind of value addition to the existing financial market architecture and market participants or not? And if they are, they have any kind of significance as part of the existing financial markets, then what should we be doing, or should be understanding and or thinking that whether we can adopt that similar product or market architecture and conventional financial structure of the hedging and repo instruments or not. And in that process, we should be keeping in mind that we should be keep assessing and should keep asking ourselves that, okay, if conventional instruments as part of derivative markets are being adopted for central purpose, what as Islamic finance students or Islamic finance industries stakeholders, we should be knowing if we want to go for that kind of instrument, or if we want to find that what is suitable for us, or to make it more stretch, if you're going to going to be a practitioner or product developer, or you want to have your own structure or product for your internal business needs or as part of your studies, what should you be knowing and you should be aware of as far as the Islamic framework is concerned that is applicable on hedging and repo instrument, and what Islamic standard setting bodies have position as far as the existing repo industry and hedging industry, and what they propose for Islamic repo and hedging instruments. So that will provide you the context to understand that is there a need of such kind of instrument, and if there is a need, what are the applicable and framework for that you should be aware of, because if you ignore that framework, you cannot develop a product, execute a product, adopt a product, or structure one or adopt one for your business needs or your financial institutions needs. So that is equally relevant as if you are working in conventional financial market, you should be aware of regulatory framework, standard practices, best practices, local laws, international laws. So Islamic finance does not impose anything which is out of context or which is not relevant and practical. There's one need, Islamic finance let you aware that you should also be knowing Islamic Sharia principles and practices, so you can do it more accurately and more beneficially, so that you can achieve your ultimate purpose. So that the context should be, once you understand that what is the significance of conventional hedging repo market, how that you should be knowing, should be understanding the Islamic finance principles position and the standard setting bodies position about that and the framework. So after that, once we finish that, to us the significance of hedging repo market, I will be briefing you about the topics that we will be inshallah covering in the forthcoming course that Mr. Hassan will update you about the time and date for that. Now, as I said that, first of all, we should know the significance, what our derivatives are, and what is their significance. Generally, there are four types of derivative contracts are there as part of the conventional financial markets. One is swap, other is forward, the other and futures and options. Swap, I'm just going to give you a bit of flavor of each of everything so that we can start building the context correctly, and we should be then focusing on what we want to achieve at the end of this presentation and this webinar. Swaps are, if someone of you are already aware, it's fine. Or otherwise, if it may provide a refresher about the nature and type of the derivative contracts. Swaps are customizable contracts between the two parties to exchange cash flows on certain rates over a specified time period. Uh, Swaps are customized. When we say customized, then the parties to the swaps can tailor and modify the terms and conditions of their respective swap contracts according to their needs. It means what? Swaps are not standardized at times. So if they are not, they offer the flexibility to customize your relevant contract. So, for the sake, what could be a swap contract, or for what purpose a swap contract can be entered into? Generally, you will find that the people are entering into a swap contract to hedge against the risk of unfavorable interest rate movement. And for example, there's a party, they are looking to hedge the risk against their position. They may be having $100 equivalent of $100 million or $100 million amount worth of debt, borrowing, or some other kind of exposure. So what they on that they will be required to make interest payment on that. What happens that party comes up with their understanding based on their analysis or some other data, that they are right now are required to make a fixed rate of interest payment on their $100 million of borrowing. But in going forward, their fixed rate interest will become more expensive, because it is generally anticipated that the uh, the interest rate will go down in future. So what they do, this to hedge against that kind of anticipated risk, they can enter interest rate swap. Uh, okay, Khaled, I'll get back to you on that, and I will request you if you can drop the message in the chat box, that it will be great. So for that purpose, to hedge against the unfavorable and anticipated interest rate movement, a party wants to hedge against that unfavorable situation, economic outcome. What they do, they enter into a opposite counterposition to insulate themselves against the unfavorable interest rate movements. So they enter into an interest rate swap. So that's one of the flavor. I'm just going here to give you a flavor of everything so that we can move to the our course outlines. Forwards, notice forwards are also customizable agreements with two counterparties. In which one party agrees to buy an underlying asset from the seller at a later date for a price established at the start of the contract. What does it mean? If a party wants to buy some asset at a future date, what they want to do, they want to lock their position right now. And for that, instead of acquiring that security or particular instrument or asset, what they do, they buy a forward contract. That forward contract gives them the opportunity to buy their required asset in some time in future, or between that from any time between that at the future, they can buy that security at the pre-agreed price. So they have the flexibility. If they feel that this is the right time, they can buy the asset at some future at a certain price, so that can have it with them in future. They can enter into a contract right now. Otherwise, if such forward contracts are not there, that party has to wait till the time that they think price is within their range as per their target, and then they will be only able to enter into that buy or sale transaction. So forward contract provides them opportunity and a contract to enter into a transaction with reference to a particular asset, and acquiring that asset right now at pre-agreed date at some time in future. So forward provides that kind of value addition. and flexibility to the counterparty. In swaps, they were able to hedge their interest rates, rate risk. In forward, a party is able to take a position right now to acquire an asset at some time of future, which is otherwise not available at that particular point of time, unless they have to wait for to actually buy and sell the transaction. Till the time they have to be just waiting and trying to assess the situation whether it's right time or not to enter into a buying a transaction or selling an instrument or selling an instrument. Futures are the same as exactly the same as forward contracts. The only difference is that forwards are customizable, means parties to a forward contract can modify the terms and condition and the nature of contract according to their specific needs. But futures are standardized, means their terms and conditions are standardized, and whenever two parties enter into a futures contract, they cannot change the terms and condition. They have to use it as it is because they are provided and set by a certain exchange where they are traded. So they have to take it or leave it. If they want to trade it, they cannot modify any changes. They cannot at the back end make any amendment. If they want that contract to be enforceable at the exchange, they have to use it as in the form provided with the terms and conditions set by the exchange. So when a forward becomes exchange traded, that becomes a standardized one, and in that case, that forward contract is called futures. So if you are talking about future, it means that you are talking about a contract which is traded on exchange. Options. Options are the contract that the option says, the term says that it's an option, not an obligation. It means if you want, you can exercise that option. If you do not want, you can let it go, you can decline. But if it was an obligation, you have to honor it either way, whether it is in your favor or it is not in your favor. So what options contracts offer, they provide you the flexibility to have the right to buy or sell something at during some period of time or at some point of time. If you feel that it is beneficial for you, it is in your interest to acquire that asset or sell that particular security or asset, so that you can exercise that option or buy and sell the particular asset. If you feel that you're not comfortable and it's not going in your favor, then what you can do, you can let it go and expire. And you not need to honor that obligation because it's never been an obligation, it was just an option. So options contracts are designed and developed to enable a party to acquire the right to do something or not to do something at their within a agreed time frame. But for that, they have to pay a premium, like generally an insurance payment is paid to have this option right with them. If they will not make any payment, they will not be having any option contract, so there will not be any right associated with that. So premium is integral part of the options contract. Options may trade in over-the-counter market, OTC, but they trade predominantly on exchanges. So that's one of the features. Now, once we have touched upon the types of derivative contracts, why derivatives are being used in the marketplace, what kind of benefit they offer. Generally said, they offer 3 to 4 kinds of benefits. One is price discovery. Dr. Abdullah, that way, I'm going to discuss whether Sharia compliant or not. I'll respond to when I come to that stage, and that is in fact going to be the theme, one of the theme of the course that we are going to discuss in the forthcoming course. But I will definitely touch upon that. I'm trying to do. I'm trying to building a context to come to that point. So definitely I'll answer that to you. So derivatives are what the benefits they are expected to offer. One, price discovery. Two, predictability of cash flows. Three, limiting risk exposure. And fourth, they help provide signals about the future directions of the market. So there are four kind of benefits that, as part of the conventional financial market, it is believes that while using the derivatives, the market participant and the economy can get the benefit in form of price discovery, mitigating the risk, predictability of cash flows, and future direction market signals. What could be the direction whether market is expecting good positive economic activity going forward, good financial condition going forward, or they are expecting otherwise. So that kind of benefit, the uses and benefit are associated with the derivatives. How price discovery is possible? Derivatives serves an important price discovery as discovery role in the economy, as they can be used for establishing the price of goods and services. What happens that? We'll see in a forthcoming slide that derivatives transactions can or contract can be undertaken on a very nominal amount of capital that is required to undertake a contract, as compared to what it will take to acquire the asset directly. So by just allocating a very nominal amount, people come to the market with very lesser amount of capital investment. They start trading in the market, and that's how the bid and offer volume and trading volume, it starts increasing. So that volume increases manifold in a marketplace. So what that provides the price discovery through a very large volume of bids and offer in on a place, and contracts that are executed on exchange or in OTC market, especially on exchanges. So that once that price trend is being set through the active bids and offer, and ultimately that translates into an execution of a derivative contract, the price, the direction provides through the market consensus based price of a given goods and services provides consensus based pricing for certain goods and services. So it helps market to know the price of certain commodity that market participant feel is optimum and fair, as far as it's based on market participants positions and exposures taken out there. So that provides a price discovery at a much larger scale. We are not going into detail right now whether there is legitimate from Sharia point of view that if someone takes a position in derivative contracts by just having a very nominal amount that would otherwise be required is Sharia compliant. We are just talking about economics that conventional financial market is concerned. Now, when used as hedge, derivatives provide investor with predictable cash flows and limit their risk exposure. How it is done? Let's say we just I gave the example of interest rate swap. So if a party is or a stakeholder is anticipating, estimating that the fixed rate is going to be expensive, and variable rate or rate in future will be going down, what they can do, they can lock in their themselves in a counter position where they can effectively making interest payment based on variable, which is expected to be lesser expensive than the fixed rate one. So they, by entering into a contract through a contractual arrangement, what they can do, they can determine the maximum interest rate exposure, interest amount payment exposure, and minimum interest amount payment exposure, so that can plan their cash flows at their financial institution or at their corporate level. So that will help them planning their future cash inflows and cash outflows, and they help assessing the bridge gap they need to bridge in between if they need to make any kind of payment at some time of point going forward. So it helps them plan the future cash flows and business activities of a corporate. So once they are able to predict, not guarantee, not for sure guarantee, not on 100% guarantee, they can predict what could be the pattern and behavior of cash flows based on their contractual obligations. They're definitely going to limit their exposure, because from the upper side, the ceiling side, they can limit it from going further higher, and from the downside, they can also predict that at minimum what could be the minimum liability, so they can reduce or eliminate certain part of their overall exposure that may be there without the derivative contract product available out there to hedge against the anticipated risk. Trading activities. Trading derivatives as a speculative tool can also provide liquidity and precise signals in the financial markets. As I said earlier, because derivatives require a very nominal amount to invest and to enter into a risk and return profile of a given asset that would otherwise be required if you want to directly go and acquire and invest in that asset. So that kind of leverage in financial capital allocation provides incentive to the speculator to come and join the market and allocate their capital to in anticipation of making maximum profit and gain out of certain position that they might be taking out there as part of the derivative market. So what they do, when they do, they join the market and execute a deal with their own kind of economic analysis and financial analysis. That financial economic analysis is embedded with their expectation and the position they are going to take as a counterparty of the derivative agreement. Let's say the party
Mr. Aamir, excuse me, Mr. Aamir, can you hear me?
That will be providing another kind of probability that, okay, if a party is anticipating a downturn, there is a counterparty available there who is willing to take the counter exposure, and that party is anticipating and estimating an altogether different kind of economic outcome. So that kind of signals the other participant of the market or stakeholder in the marketplace economy can drive out from that kind of trades and activities out there as part of derivative market. They can sense, okay, if a party A is expecting something, there is another version of the analysis that provides some other kind of information embedded in a transaction of derivative contract execution. So that's also provides signaling. Okay, the speculative signaling otherwise it's not needed, or it's not compulsory that everyone should be agreeing to that perception, but at least that serves as an input to the other market participant. Okay, what could be the other likely outcome of the economic condition or financial condition going forward? Now, if you look at we have touched upon the types and the benefits that are generally believed are offered as part of conventional financial system by having an active derivative instrument market. You can see if you look at the column of users, you see that almost every kind of key economic participant or player is part of that list. Commodity product manufacturer is very much integral and important part of an economy. Multinational companies, life insurance, corporate treasurers, construction firms, be it infrastructure projects related to construction activity, housing construction related activity, or some other kind of construction activity. Construction firms are there. Exporters, countries who exports and earns valuable foreign exchange through exports. Exporters are there and are very valuable part and parcel of an economic activity. Bank loan and portfolio managers, equity investors, governments. So you just have an idea that what kind of users are there who are utilizing the derivative contracts from the developed derivative financial instruments market. So it means it's almost all encompassing. If you are, let's say, a wheat commodity manufacturer trader, or palm oil, or let's say crude oil, or some other kind of commodity, or wheat, or rice, something else, cotton, what you do, you're selling it but you or you are buying it, whatever it is, you feel that you need to hedge your risk, what you will be doing. What you need to know that, okay, if you are expecting a certain adverse economic activity that can impact your profit loss account, your profitability, and your balance sheet, what you can do, you can go to the derivative market and acquire or buy a contract to secure your position for mitigating the risk that you're expecting can be there because of your business activity or because of the financial exposure. So commodity, the market is there that as part of derivatives that provide commodity-linked derivatives. Multinational companies, funding costs of foreign debt issuance, they raise loans from international market in foreign currency, international financial currency denominated transactions or in local currencies. And they might be feeling that they are on the opposite side of the risk, which is going to be there in the future, and they want to hedge against that risk. So they go to the market, derivative market, and avail cross-currency swaps or FX forwards, foreign exchange forwards. So multinational are very much part and parcel of that market as well. Life insurance, the whole model works on based on annuity and interest rate expectation and environment, and their payment and payment obligation and cash flows predictability. What they do, they could go to the market rate and avail interest rate swaps or options. Corporate treasurers, again like multinational, they have to again secure their position against their liability side for the funds they have raised in terms of borrowing or long-term loans or whatever types of obligation they have raised on their balance sheet to fund their businesses. So if they feel the interest rate environment is not going to be in their favor and they might be running losses because of the high cost of interest expense or some other kind of exposure, so they have the facility to go into the market and avail of forward contract. Construction firms, they need cement, iron, steel, or other kind of commodities, and they buy it. And in fact, they want to, and when they buy it, they have an exposure on that, and they have to make payment or they have to sell it, they have to buy it. So they want to, again, because their contract is very tightly negotiated and their cost element plays a very important role. So if that goes out of proportion, their whole contract or construction project might turn into a loss-making unit or project. So what they do, they go to the market and avail a commodity derivative to hedge against their expected risk. Again, the common feature is they want to make the cash flows more predictable, and they want to reduce the risk involved as part of their business activity. So they want to limit the risk. Exporters, again, they cross-currency swaps. They want to secure against unfavorable foreign currency exchange movements. Banks, credit default swaps. Equity investors, equity derivatives. Government, they issue international sukuks, they issue international bonds, and there is financing in foreign currency. So they have to make their interest payment as well. What they do, they have the opportunity to go to the marketplace and raise and acquire or avail interest rate swap. So that's give you the flavor what is the depth and width of conventional financial markets. Now, when I'm saying this, I again request you to keep in mind whether Islamic finance needs all these kind of things or not, or if a commodity manufacturer is there, and if that commodity manufacturer is looking to hedge its position against unfavorable price movement, would it be non-Sharia compliant or Sharia compliant, or if it is allowed in Sharia to have risk mitigating strategies in place? So whether existing conventional financial market instruments are compatible with them or not. We know it. There a number of fatwas and Sharia opinions are there. They are not Sharia compliant. That is why we are having this kind of webinar to launch the course, and that will be followed, inshallah, with the 3-day or some other time duration course related to that. We want to discuss that if these instruments or product are not Sharia compliant, that what Sharia says about that. And if Sharia says about that, what Islamic finance industry has done to address that issue. And if they have done to address that issue, what kind of a regulatory framework is available to make it sure that you can remain Sharia compliant while working on that kind of products. And if you come up with a kind of product that is Sharia compliant, Would that be exactly like this, the commodity, the derivative instruments that are in practice or being executed in the conventional marketplace out there? Or you need to have some modified version or some altogether different version of that from scratch? So that's the purpose of having an understanding that we expect to provide during during our proposed course. Now, once we have discussed the benefit and the type, depth, and width of the market, now look at the significance that is there in terms of the global derivative market as part of the international global financial market industry and activities that are being taken. Because people need it, and when they are not concerned with the interest rate and some other thing, they just focus on their business sheet and they go out there and acquire their required kind of derivative contract. So it's not every part or not every country in the world is concerned with the Islamic finance. So we are trying to build the scenario here that what the kind of scale is there for derivative market and how integral it has become for the businesses, for the government, for the commodity manufacturers, for the exporters, and for the rest of the sector participant of the stakeholders of the economy, plus the speculators as well. So at the end of 2020, what BIS, Bank for International Settlement, tells us is that almost $607 trillion were outstanding there in terms of notional amount that was associated with the global derivative market. It's not, I don't have word to explain it. It's not just huge. It's humongous. It's any kind of superlative expression you can use. $600 trillion, huge. But notional, it's about notional. Notional means that it's a reference amount. And it's a reference amount. It means neither of the parties required to make or settle the $607 trillion whenever their respective contracts will come to mature and they are required to make payments. It's for the reference purposes only. So that's again a point that we'll be touching upon and going forward. What that the notional outstanding amount and the other concept that is there as part of the derivative market industry signifies and have message for you if you look at from Islamic finance principles and restrictions that are placed for dealing in derivatives, conventional derivatives. So that's will show how the financial engineering and how the financial leveraging is being used to take exposure in the conventional derivative market, and actually what is the amount that is being spent and what is the notional amount that should otherwise be spent if no derivative was there. So I will discuss that in the next slide with you. IRD stands for interest rate derivatives. By again at the same time, end of June 2020, almost 82% of derivatives was just entered because to secure the risk against the unexpected risk movement in the interest rate environment. So it's simply all interest rate based or linked derivatives market out there. The next noticeable was the foreign exchange derivatives. It means that it's mainly is to hedge the risk against the unfavorable price movement, so that whoever is going to hedge the risk against unfavorable interest rate movement wanted to secure their profitability, wanted to keep intact their profitability, and they do not want to erode their profit loss account, and they want to secure the liquidity and their balance sheet as well. So that's the impact you can see. If 82% almost is going to be managed through derivative contracts to secure risk or limit the risk, then it means it's all mainly driven by interest rate environment. This table again replicate this same data with the with an exception that the data is provided here not of only 2020. It starts from 2005 and it is till 2020. Notice one thing. Even in the year of 2008, which was the year of the peak of global financial crisis, 2008, the share of interest rate derivative in the market of overall market of global derivative was 75%, which is three-fourths. And that was the lowest ever. If over that period, to 2007, 2008, that was the lowest ever share of interest rate base or linked derivatives in the overall derivative market, and that went up to 84% 2014. So if you see that at minimum, at an average, you will find that around 80%, 70 and 80% share is only attributable to the interest linked, interest based derivatives. So it's market driven by interest rate derivative. If you take out that element or share from the global derivatives market, the volume of that $607 trillion will go down to around 120, $150 trillion only. It means around $400 trillion will be wiped out. Will be wiped out because if there was no interest rate environment issue, there will not be that much high amount of derivatives out there on notional basis. So that shows the composition as well. So side by side, what I'm going to do, I'm going to try to tell you the dynamics of convention versus the Islamic finance principles and what could be the Islamic finance framework and expectation from the market participant. Now, I just mentioned that I was talking about notional amount, but that was again, notional amount was not relevant for assessing the actual financial risk involved as part of the derivative market. What happens is that if you want to actually assess the risk involved in the derivative market, you need to know what is the gross market value of all outstanding derivatives contracts. Just look at that. I'm just skipping that. This what is actual the gross market value is that actually what you need to make payment if you have overall position your negative or positive contracts position with you, and how much amount you as an individual party you would be required to make payment based on market values. Based on market values. So that means that measure tells you actually what is the risk profile and what is the level of risk max of a derivative market if you want to make if that comes to make an actual cash flow settlement on gross basis, right? So look at the final point that when the people start taking exposure in the nominal market, which was of around $607 trillion by just allocating around 15.5, that is all in all $16 trillion of capital required. So the market participants were able to take a position in the overall risk and return profile of the total asset volume that was around $607 trillion by just allocating investing around $16 trillion. So that's kind of leverage that is being used to take positions in the derivative market. That's around 2.6%, only 2.6%. It means if you want to take indirect exposure against an asset with around 100% risk return profile benefits, you can need to allocate only 2.6% of your capital in that. It means you want to have exposure in $100 million asset, you only need $2.6 million amount to take exposure against that. So that's the riskiness that is there. And look at the next slide. Again, that's from 2005 to 2020, and at an average around 2% to 2.5% was the average rate or the amount of capital required to take exposure against the notional industry in derivative market. It means if you want to, without allocating $607 trillion capital, you can only allocate $16 trillion and you can enjoy the benefit, risk and reward benefits as per your anticipation expectation by just allocating 2.6% or 2%, 2.5% of the capital amount required. So that leverage brings riskiness, introduces riskiness in the marketplace, which is not promoted and encouraged by Sharia, which is in fact opposed by Sharia. So what is Islamic finance says about that? What should be the framework and Sharia position and standard bodies position out there, what they promote or what they restrict or what they allow. If you want to enter into a genuine, real transaction-based hedging instruments, what you need to know about that is that kind of exposure is okay or not? Or if that is okay, then what are the framework that makes you eligible and allow you to take position in such kind of instruments? Otherwise, if that becomes non-Sharia, non-compliant, you have to make it a charity for that, and you will be also running the risk of a reputational risk. So that's the context we are trying to build here. Now, again, the question I received is that whether they were Sharia compliant or not. In the conventional industry, that has also prompted a number of issues and concerns by some notable personalities and the forums out there. And since the 2008 crisis prompted G20 forum, which is a forum of most developed, economically developed countries of the world, they were become concerned as well how they should handle that issue of derivatives because of the nature of that. So, and they came up and they took initiatives to address the issue. But even then, they addressed that issue. Still, there are analysts who feel that the mispricing of derivatives and taking leveraging position at derivative is still making this market more riskier, and there is a risk involved that can again surface and disturb the overall market at the global scale. And it further says that banks might find it cheaper to shift risk using derivative contracts because, as I said, instead of allocating $100 million, you just need to allocate $2.6 million and take a maximum risk position that you can take. And what is this at this stake? $2.6 million, not $100 million. So it's the biggest advantage. So that is the thing. And again, it has sparked debate whether the conventional instruments should be supported or not, or how they are regulated. So before coming to Islamic finance, even conventional finance sector industry and regulators and market stakeholders are not comfortable with that kind of instrument. Professor Raghuram Rajan in 2005, who was the former chief economist of IMF, he himself warned that perverse incentive coupled with wrong monetary policy could lead banks and investment firms to take excessive risk. Again, we have seen in 2008 onwards, because he said that in 2005 and they materialized in 2008. And again, we are still there are risks, there are fears that can happen again. Professor Nouriel Robini of New York University described the perverse incentive culture of investment managers. What he said, people were essentially being rewarded for taking massive risks. In good times, they generate short-term revenues and profits, and therefore they earn a lot of bonuses. But that's going to lead to the firm to be bankrupt over time. That is actually a distorted system of compensation. Who is Professor Nouriel Robini? He was among one of those financial economists and financial experts who predicted the 2000 financial aid crisis beforehand. And he is the same person who is now predicted about the stagflationary debt stress globally. And he's saying that it's kind of a new thing that's going to emerge out of that. He's a very well-respected economist and financial expert out there from New York University, and he has that kind of comments about the risk involved in the conventional instruments. Some views. They are definitely powerful tools that can help manage risk and limit investment exposures, but they can lead to excessive speculative trading and significantly increase investor risk profile. And they can be mispriced, they can distort the financial system, and they can endanger the entire financial system. So that's the context we are seeing. And what if we feel that, okay, that's all not correct and that should not be happening, then what we should do now? We should know what Islamic finance has to say about that, and what should be the framework we should be following, and are there any existing products that we can use for good or not, or these products are not completely fit? What could be the options? And as a market participant, a practitioner, and a student, how we can develop that kind of expertise to develop an understanding that if we want to come up with some kind of structures, or if we want to execute adopt the existing solutions that are already made Sharia compliant by the Islamic financial industry, how to use it. Because in execution side, you need to be aware that you should not render a genuine transaction and non-Sharia compliant. So you need to, what framework is there? You need to, what understanding you need to have as a student. You do not need to be a practitioner always. At least executioner or executing a transaction, you need to have an understanding, like you need to know what are the capital market rules are, what are the capital market practices are, what are the framework is required is there if you're working through a stock exchange or working for a company, what the governance standards are there. So similar is applicable in having understanding about what framework is there for Islamic finance. Repo, let's briefly touch upon repo. You have a very good quality instrument with you as part of conventional industry, and that's giving a very good return. But you do not want to sell it. What do? You prefer it to sell it in 1 lakh of a transaction and immediately buy it back from the counterparty. So what you will be doing that you are generating cash from the sale transaction and having the ownership and title of the same instruments simultaneously. Effectively, you're not selling the instrument, you're using like a tawarruk kind of thing, which is not permitted in modern tawarruk, which is not permitted in Sharia right now. So you sell it, you sell an instrument, you may generate cash out of that. You use it as a loan, and you buy it from the counterparty immediately. And when the time comes, you make payment and you get back your instrument from the counterparty. So that is the basic thing about repo. And repo is said to be a precursor of the potential of developing a derivative market. If you look at the last point, that the attempts have been unsuccessful where there have been no active repo market to facilitate trading, hedging, arbitrage, and pricing to establish new derivative market, OTC market. What does it mean? Repo is relatively simplest form of the financial instruments out there, and that engages fund provider and borrowers. It means who have liquidity and who needs borrowing. So that helps create a marketplace for park arrange liquidity. When that market is there, it means borrowing, lending, active basis is there, and risk taking, risk passing culture is there. So that helps provide a basic foundation to go into further complex and structured solution like derivatives. So as per the study, if there is an active market repo market there, then there is a more likelihood that you can have a successful derivative hedging market there. So that's the precursor. Now we will do as part of that. We will covering this concept of the course. We have assessed what conventional market is doing, and we know what they're doing and what is the market completeness concept through which the conventional market is working, and if they are working at that, is whether it is suitable for the Islamic finance industry or not. And if it is not suitable, then what are the choices? And if you want to do something, are you aware about the AOIFI framework? Do you have time and research to know most of the things that are prescribed by AOIFI through consensus based on the diversified base of Sharia scholars? If you do not need to do that, you cannot undertake a transaction or do anything or move forward with that. You will be finding difficult every time to take a transaction and make it successful every time. What IIFM ISB have on repo and hedging, and what kind of initiative they have taken, what they have proposed to be more Sharia compliant and to make execute Sharia compliant, what they expect from you to do, and what they have provided you as a format, which is a format agreement, which is compatible with Sharia. So in the first topic, that enables them to do conventional derivatives. Can Islamic participant do that or not? So if not, then what is the market completeness concept from this Islamic finance perspective? If you are able to understand that, things will become more clear to you and more understandable to you. Okay, what market type should be there, that if there you come up with a derivative instrument or you use the existing approved Sharia approved standard to hedge against the risk, what kind of Islamic finance market should be there, what feature should be there that will not render your existing transaction to non-Sharia compliant. If you are a correct product, but if you go to the conventional market, adopt the same structure, that transaction will be qualified and rendered as non-Sharia compliant. So what you will do? You need to know how you execute it and what care you have to take while undertaking exposure and making entry and exiting from that exposure. So you need to understand the marketplace, type of marketplace, and what you need to be careful about. Now, what is permitted by Sharia? Generally, the common forum, every country has their own Sharia standards, but AAOIFI is a platform that is there to converge the differences and provide you more consensus-based Sharia opinions to follow, or guidelines to follow across jurisdiction to help you become more global in practices and business and approach. So what is permitted at AAOIFI, what is not permitted by AAOIFI, we'll discuss that, we'll see that. And what we will be doing for you, we will be collecting all the information for you in that course to let you know what are the relevant standards out there that you need to consider and what they say about hedging and repo and what are the relevant things that you need to be aware of while going for that. So we'll do our best to apprise you about the framework. The direction and framework is provided by AAOIFI to be aware that these are the things at least you should be knowing before taking an exposure or transaction, and you should be mindful and should be having knowledge about if you are doing or structuring some transaction or going for a structure. Again, without IFSB, Islamic Financial Services Board, who is the regulator of Islamic Financial Bank, like BIS for conventional banks. So if what IOFI is in favor of taking position hedging or repo or not. If a financial institution takes a position, is IFSB supports that or not? Otherwise, that's going to directly hit the capital adequacy levels and buffers and ratios. So if IFSB is not in favor of that, what will do? How are you going to manage this? Or if IFSB is in favor of that, what is its position and what it recommends? Now, and what similarly, IIFM in Islamic International Financial Market, what they have done by now to provide guidance, to provide instruments, to provide structures. That course will give you a flavor that what they have done by now, what products and structures they have developed to facilitate Sharia compliant repo hedging activities, and what you should be at least knowing about that. We will not be discussing each and every point about that. We will be discussing a major framework for your benefit, so you can later on, if you want, you can go deep down to that and can understand what you need to do further. And in that part further, we will provide a reference to the relevant models, key features of what IFM has done to enable you to undertake hedging repo activities, and side by side what they have proposed as generic structures for repo hedging models. Besides focusing on IIFM provided structures for hedging and repo, we will also be touching upon the other practices that are going to be that are being practiced out there in the Islamic finance industry in different jurisdictions, be it repo and be it hedging instrument. So the intention of this course is to apprise you about what you need to be knowing, what you need to knowledge you should have from Islamic finance perspective, standard setting bodies perspective, the Sharia compliant structure for repo, which are generally believed to be more Sharia compliant or 100% Sharia compliant, and what are their structures and what care you should take about you should care about while executing that deal. Because if you adopt the correct structure, 100% approved structure, but if you due to any reason ignore the compliance of that from Sharia perspective, that ignorance might render whole transaction riba based. Though the intention was there to make the genuine benefit out of that, the whole transaction will become non-Sharia compliant. So there will be no benefit for the institution to whom you are working with or for your own benefit. So that's the understanding has to be there. And that capacity, at least if you not want to structure a deal or a product, at least you should be able to understand the structure of a deal, how it works, what is the components and modules of that structure, what is the purpose of that, and at what step what is being achieved, so that you can understand, you can relate to transaction in a more better way and more informed way. So that is the thing. If you that's now the question answer session. I look at the Q&A. First question was by Dr. Abdullah Shoaib. Towards extent are futures forward and options Sharia compliant? In most of its existing forms, it are not Sharia compliant, because I have told you, I've explained the reasons as part of this presentation, that even the conventional market participants are not sure about, not comfortable about the structures and features of that. So that's why Islamic finance industry is still working on to come up with the Islamic finance version or altogether new instruments for that. And that is why IIFM is there and IOFI putting the effort, and IFSB is there to provide its input. Shakir Hussain will say, are derivatives only to mitigate the risk in contract or wipe out the possibility of risk completely from the contract? That is, yes, that is the point. That is the point, and that is the purpose. They are there to mitigate the risk, and there is no other activity. So that is the risk, the main purpose of that. I hope the all slides made available to us, and recording is here. That Asan will help you in that. I hope. Okay. Uh, what was the answer for that? The differences between repo and reverse murabaha, are they regarded as haram? Between repo and reverse murabaha, Charles, again the point is the mechanics behind repo is not Sharia compliant, because that's the more sensitive issues nowadays Islamic finance industry that involves tawarruk. And there's a lot of discussion going on that there have been certain guidance about that from Sharia, from AAOIFI, from other corners, platforms, and now it's again being taken very seriously. So repo, if reverse murahaba is going to replicate the substance, economic substance in real form of repo, then it's not going to work out for you. That is the challenge. That is the challenge. And I have an opinion about that, and I'm a practitioner and practitioner as well. I have developed a few products which are under corporate law, right laws, and that are actually used for capital market transaction to raise, mobilize, and financing and offer some solutions. So I'm an investment banker and I'm a product developer, structuring expert as well. So if you want to look into that thing, you need to clear one thing in your mind. You need to understand what is the concept of a market in Islamic Sharia. In my opinion, if you resolve that issue, what is the requirements of and what is the structure should be of a marketplace in Sharia, then taking indirect position through other comparable conventional market will automatically will eliminate. What I am feeling, what I have been observing is that people not focusing on the marketplace concept. What they're doing, they're trying to utilize the or leverage on the existing financial architecture that is there. So if you can keep missing out that thing from your perspective, your activities, you will be ending up with finding out unfavorable Sharia ruling that will stop you from taking positions. And I have discussed in one of my earlier courses that I had done from an international courses done a few days back. I have also tried to make people think that they should also start focusing what is a marketplace. Is has to be a huge marketplace, or you have some kind of marketplaces part and parcel of your economic system that can be utilized as a market where you can take exposure through and make it more Sharia compliant. I've done that, and I'll try to do that in course too that inshallah I'll be conducting. Farid Razak, derivative option Sharia compliant. Uh, in its current form, it's not. In its current form, it's not. I hope I have answered those questions. Now, if there are no more questions, I will request
Jazakallah, uh, Mr. Mohammad Aamir. Thank you very much for the insightful session. And I believe the questions people have asked are quite relevant,
okay.
and they must have been answered. So I want to thank you, whoever have joined the session. Specifically, this is a course launch webinar. So in case you want the certificate, you can email us specifically, then we will issue a certificate. With regards to the forthcoming course that will be happening in January 2023, approximately after 25 days from now. Date will be announced soon. As long as we receive your interest, we will develop. The course outline is ready. If you want me to send it to you, I can send it to you. And the course will be a 3-day training, 2 hours each day. It will be a live session like this. You will be allowed to ask questions in between. Anytime you can ask questions, you don't have to wait until the end of the session or anything. So that would be more convenient. This specifically, this I will ask Dr. Aamir to tell who will benefit, who are the people who will benefit from this course. If you could list down or name those people, so people will have an idea how this course will benefit them.
Should I respond it right now?
Yes, yes.
Okay. Uh, as I said, as part of my discussion, that it can be students who are preparing or having developing their basic understanding. It's high time for them to have understanding regarding that, because that will enrich their knowledge when they will enter into the industry and practical life. They will be more better equipped with the practical perspective and understanding that how they should approach and handle the responsibilities and deliver what is expected from them. It is also equally relevant for corporate treasurers, corporate business people, the people who are there working with the product development side, Sharia side, or the treasury side of or corporate banking side of financial institutions, asset managers who are there who want to understand, because generally unless there is a specific focus session, people find it difficult to gather all the information in one place and to discuss or to hear about that. So I think it's a very the audience base is quite wider for Islamic finance stakeholders and people and instruments and the professionals. They can be equally important for the CFOs and finance managers, because one way or the other way is going to affect you if you are working in a corporate in a financial institution, or if you are a student preparing for your practical experience, practical career. So if you know that, you are better equipped, you're well informed before taking any transaction, and can add value to your respective institution or your careers. Thank you.
Exactly. So there's one more question in the Q&A. After that, we will inshallah wrap up the session.
It's fair to say that conventional financial system has learned anything from Harun Rashid. I won't say that, because let's say if we associate ourselves with the Islamic financial system, but people who do not relate themselves with the Islamic financial system, but they and then even may not be aware with the Islamic finance side as well. They are working with the conventional financial system. So what they do that uh, uh, they have tried to learn them best according to best their energies and understanding the resources to tackle that issue. They are still in the process of doing that. There is a realization that they keep continuing in that direction to let the thing does not happen again. So they have learned their lesson, but this Islamic finance, what Islamic finance says that beforehand tells you, if you go into that kind of thing, you are going to have it. But for them, it's a learning curve process. They learn, they do something, they make mistake, again learn, they make mistake, they learn, make mistake. So it's an ongoing process for them. But because we have divide direction for the benefit of us, so we remain focused. they keep learning, they keep doing, they keep mistaking, they again keep learning, they doing. So that's the thing. So it will not be fair to they have not learned their lessons. In their capacity, they have learned their lessons. But something new comes out, and they again find struggle with that and try to come up with solutions. So from the, in a generic sense, they always learn their lessons. But the thing is that we are aware that riba based system is not good for the humanity. They are not aware of it. So that makes a difference.